Most investors chase trends, but the greatest investors, they chase value. From Benjamin Graham to Warren Buffett, from Charlie Munger to Rakesh Jhunjhunwala, value investing isn't a trick, it's a timeless philosophy. Today, on Money Wisdom, we break down the what, the why, and the how of value investing, so you can invest not just with your money, but with wisdom. What is value investing? At its core, value investing is buying a great business for less than its intrinsic value, and then waiting patiently for the market to realize that value. This idea was born in the 1930s with Benjamin Graham and David Dodd. It was made legendary by Warren Buffett and Charlie Munger. Value investors look for businesses that are fundamentally strong, undervalued by the market, run by competent ethical managers, and are positioned to compound wealth over time. But let's also bust a few myths. Value investing is not buying the cheapest stock, or chasing low PE or low price to book, or avoiding tech stocks just because they're expensive. Value investing is neither a get-rich-quick scheme or some technique about timing the market. Remember, cheap is not value. A stock can be cheap and still a bad investment. What matters in value investing is, what is it worth and what are you paying for it? Why every investor should consider value investing? Because this isn't just a path to wealth, it's a path to financial freedom. Let's talk numbers. If you invest $10,000 at a 15% compound annual growth rate, here's what happens over the long term. In 10 years, it grows to approximately $40,000. In 15 years to $81,000. In 20 years, it becomes $164,000. And in 25 years, it will compound to over $329,000. That's the magic of compounding, when mixed with value and time. Let's take few real-life examples. Warren Buffett's Coca-Cola investment was bought in 1988. He is still holding it with 1,500% plus return. In India, Rakesh Jhunjhunwala's played the Titan bet, turning rupees 5 lakh into 5,000 crore rupees. Time and conviction did the magic for both and many other successful value investors. In a nutshell, value investing helps you earn passive income through dividends, build capital appreciation, and achieve freedom of time and choice, the true wealth. How to start value investing. Let's now go from theory to action. Here's your real-world value investing playbook. Step 1. Understand the business. Before you invest a single rupee or dollar, understand what the company does, how it makes money, and what competitive edge, also known as moat, it holds. Dig into annual reports, management commentary, and the company's long-term vision, just like Buffett reads hundreds of pages a day before making any investment decision. Ask yourself, would I be happy owning 100% of this company? Step 2. Determine intrinsic value. Intrinsic value is what a business is truly worth based on its future cash flows, earnings power, and economic moat, not what the stock market says today. Use valuation methods like discounted cash flow, DCF, earnings power value, EPV, and sum of the parts, depending on the nature of the business. Step 3. Seek margin of safety. Even the best investors make mistakes. Margin of safety is your insurance. If you think a company is worth $100, try to buy it at $70 to $80 to protect against unexpected risks, market downturns, or errors in your valuation. Step 4. Think long-term. Great investments need time to work. Compound interest is most powerful over decades, not months. Value investing isn't about trading. It's about owning slices of businesses and letting them grow while ignoring short-term noise. Warren Buffett's massive success as an investor is less due to his investing acumen and more because of his long-term investment horizon, more than 75 years, which is hard to achieve by any investor. Step 5. Monitor, review, and reflect. Check the business performance regularly, quarterly or annually, but don't obsess over daily price movements. Update your investment thesis only if the fundamentals change, not because the stock is volatile or the media is panicking. Do's and don'ts. A quick recap. By now, you would have greater clarity around the concept and power of value investing. Let's have a quick recap. 5 things you should ensure as a value investor. Study the business. Focus on fundamentals. Be patient. Track cash flows and think long-term, i.e., in decades. There are also few things you should never do as a value investor, like don't chase tips, never buy hype, don't expect quick riches, don't time the market, and never sell in panic. Tools and frameworks. Which books to read? There are many books on value investing worth reading, but to begin with, you can read the following 3 books. First, The Intelligent Investor by Benjamin Graham. It's a timeless manual on value investing fundamentals, focusing on investor psychology and margin of safety. Second is Common Stocks and Uncommon Profits by Philip Fisher. It emphasizes qualitative factors like management quality and innovation, complementing Graham's quantitative approach. Third book is Poor Charlie's Almanac, a compilation of Charlie Munger's wisdom, mental models, and investing principles, blending logic with long-term thinking. Which websites to use? TIKR.com, a global equity research platform providing detailed financials, valuation metrics, and historical data for fundamental analysis. Morningstar. It offers analyst reports, valuation estimates, and star ratings to help investors gauge long-term potential across global markets. Screener.in, a free, powerful stock screening tool for Indian stocks that lets you filter based on financial ratios, ROCE, debt, growth, etc. Key mental models and ratios. The most important is economic moat, a company's sustainable competitive advantage, such as a brand, cost edge, or network effect that protects long-term profits. Next is Return on Capital Employed, ROCE, which measures how efficiently a business generates profits from the capital it uses. Higher is better. Next is Debt-to-Equity Ratio, which helps assess financial risk and balance sheet health. Value investors prefer low or manageable debt levels. Valuation frameworks to be used. To begin with, you can use Graham Checklist to evaluate companies based on earnings consistency, debt levels, dividend record, and more. Simple, but powerful. You can download Value Investing Checklist for the description box link. Next is Greenblatt's Magic Formula, which ranks companies based on return on capital and earnings yield to identify quality businesses available at cheap prices. Third is Margin of Safety Principle, which is core to all value investing. It says that never invest without a buffer between price paid and intrinsic value to allow for errors and uncertainty. Value investing is a philosophy that rewards the patient, the curious, and the disciplined. It's not just about beating the market. It's about mastering yourself. Because in the end, the most valuable asset you'll ever manage is your own behavior. So here's your takeaway. Buy good businesses at great prices. Hold them long enough to see magic, and let wisdom, not noise, guide your wealth journey. Tell us in the comments section what you expect from us in future videos. Subscribe to Money Wisdom, where real investing wisdom meets simple storytelling. Because wealth isn't built overnight, but it is built, one wise decision at a time. Money Wisdom. Invest, simplify, grow.